Now, I'm going to get into how I look at a chart when I first open it. Now, I like to have good chart structure with my EMA. So for an uptrend, I want my 10 EMA on top, my 20 EMA below that, my 50 below that, and the 200 on the bottom, which isn't showing. I guess there just isn't enough data. But I need them in this correct order, and I need it to be smooth. You can see it's smooth. We have nice fanned out EMAs. That's what I like. That's how I know I'm going to make some money. I'm going to go to bed richer than I woke up because I have a directional balance, and that's what I like. Because in Forex, a lot of people say, oh, well, it's the most volatile market ever. You can't predict this. You actually can. You just have to learn patience. And I think that comes with time. And I think it comes with you losing a little bit of money, as bad as that sounds. Because when we all get into it, we all had the goal of getting rich really fast. And sometimes it happens, but why risk it? Just be in the game for a while and trade your heart out. Now, whenever I see proper chart structure like this, the number one thing that goes off in my head is little dollar signs in my eyeballs. It's like dinging back and forth like I hit the lottery in Vegas. It's like, oh gosh, I'm just about to go party. I'm about to go buy whatever the heck I want because I'm seeing all this money flowing in me because I can see where the market's going. And I use two other indicators to help me with this. But for right now, you can see we have a trend. So whenever there's an uptrend, there's no other thing to be doing but buying. I don't care what people say. I don't care if you use Fibonacci retracements, blah, 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 trend lines, and all this fancy stuff, calculations, and you play your dragon game 40 times a week, and it taught you how to do geometry on a chart. It's not going to help you. I don't even use anything else for a directional balance. I don't use indicators except EMAs on my chart. Now, I use two others to help me with the strength of the trend, but I don't use indicators first. I look at price first, and then I move down to my indicators to confirm what I already see. Now, whenever you look at a chart and you see these good, smooth trends, the number one thing is you have to be looking for this. You can't have them all scrunched up. Don't have them scrunched up like this. That's no good to me. I like smooth. You can tell if you ask a baby, a 5-year-old, if you said, here, little baby, is this going up or down? And if he could talk, he would just say up. That's how simple you need to make this. Now, if you look at it like this, just from the side, yes, it's going up. But if you ask him to look, what is it doing with just this data? If you cut it off, he would say, it's going sideways. Now, we have ways to trade that, but it's not something you can stay consistent with unless you learn our strategies. Now, and I'm not guaranteeing you any money at all in Forex, obviously. I think you all should know that. You just understand what I'm saying. Trends are better than sideways markets. Now, when I'm looking to trade trends, the way I do this is I go in understanding that I can only lose 1 to 2% of my account. If it's a really good looking trade setup, then I'll go maximum 2% of my account. I don't go one dime over. Now, I don't do this, and I don't take a trade before I measure my stop loss based on my account size, and I don't say, oh, well, my account's this much, so I'm going to be able to lose this much, and I'm going to do whatever trade size that I want. No, that's not correct. The professional way to lose 1 to 2% per trade, is to calculate your stop loss first. And I'm going to show you the tool that I use to make it really easy. There's a bunch of math and stuff and formulas, and you can email me if you just want to know the formula of it. But to me, I just use a calculator because I'm not in the mood to pull out a calculator, ding it all up before I take a trade. I just punch the numbers in online, and it's a free tool, and I'm going to show it to you right after I measure some of these, and then I'll show you how to do a position size. Now, what many people don't realize in Forex is that when you're trading 1 to 2% of your account balance maximum, that it should be 1 to 2% maximum if your stop loss is hit. Now, I know a lot of people that go trading and they have a certain set in stone pip value that they want to lose per trade. That is absolutely wrong. You can't do that. And the reason why you can't do that is because trends develop, and until the stop loss is broken, the trend is still valid. Now, even if the trend is kind of going sideways and it may have been at an uptrend or a downtrend for a while and it's still below our stop loss, the trend in our favor, or our biased opinion, is still in the direction we were trading. That's why it's so important to understand true price action mastery and true trend analyzation. Say that 3 times fast. I almost got tongue twisted. I didn't want to sound silly, so I had to pause. But until a stop loss, a high or a low, is broken, the trend is still valid. And if you guys hear my dogs bark, I'm not sure if you can or not. They're coming in from the backyard and they're absolutely crazy. So if you hear them, just ignore them. But I'm going to show you how I calculate it, and I'm going to get right to it. Now, right here, this is just a smooth uptrend. You can see we have smooth spread out EMAs, and I'm just going to do this right here because you can see this massive blue candlestick right here, and we had some resistance right here. I didn't plot it perfectly. I'll move the line. Now, let's just say you wanted to get in a little bit above this resistance zone right here. So this is what I would be doing as a breakout, and I look for very certain things for a breakout. So now, if you decided to get in on this trade going to the upside, what do you think would be a good stop loss for you? This is a daily chart. It doesn't matter what chart you're on. It could be a 1 minute, 5 minute, monthly chart, yearly chart. It really does not matter. A trend is a trend. Price action is price action. Now, I usually don't go lower than a 1 hour chart. My charts of preference are 1 hour, 2 hour, 4 hour, 6 hour, 8 hour, daily, and a weekly. Sometimes I look at the monthly, but that's very rare because it takes a lot of movement to move the monthly. That's just kind of for a directional balance if you want to hold trades for a few months, but I don't ever do that. I usually hold trades anywhere from like 24 hours to a whole week. So that's basically what I do. I don't trade any longer than that. But back to if you decided to get in right here, the stop loss is just below the previous low of where it went sideways at. So you can see we kind of went up and then we just went sideways for a little while. And this is a daily chart. So each one of these candles represents 1 day worth of data. So this is almost 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days worth of sideways markets. Now you probably could have traded that on a faster time frame, but I know a lot of people that only trade daily charts. So let's say you decided to get in once it broke resistance and you wanted to know your stop loss. Now I'm using a broker right now that has an automatic ruler tool. Now what I would do for this is I just measure the previous low of this little sideways thing, because you can see this is still an uptrend, and as long as we don't break this right here and go down to the up or downside, we still have an uptrend. Our EMAs are fanning out. They're nice and smooth for us. We can tell it's an uptrend. Until this is broken at the bottom, there's just simply no selling opportunity. So the way you do a stop loss is below the low or the high of the trend. So for uptrends, it's going to be the previous low. So say you decided to get in right here, or you wanted to get in right here, right above resistance, you would just simply calculate how many pips below the low is, and I'll just round it off and I'll just say it's 150. I'm not going to be precise with this. It's just to show you how I do my stop losses. Now I'm going to put these down on a piece of paper, or I'll just show you how I do it. Now this is for an uptrend. Now if you were doing a downtrend, I'm going to do an example of that. I'll show you how to do that as well. But for uptrends, you're just putting it at the previous low. So it doesn't matter if it's a 1 minute, a 5 minute, a 15 minute, 1 hour, 30 minute, whatever you like to trade, whatever you feel comfortable with, it's always at the previous low. And then before you take the trade, you have to calculate how many pips that is. And then you can use this calculator that I'm about to show you to give you a maximum loss of 1 to 2% of your account. Now, the reason why this is so important is because so many people lose money for no reason, because they think the trend is going to just automatically reverse on them and they need to get out, and they're like, oh gosh, I lost all this money, it's going to go in this direction, so I'm going to close it, I'm going to get in that direction, and then it goes back up in the original direction that they thought. This happens because the trend isn't broken, the previous high or low isn't broken, and you're just going to lose a lot of money like this. So it's best to have it like this. So the previous low right here, you can see, I'll just look to the right, it's around 1.15450. Let's just put it at that. So that's that's where it would have been broken at. So it's a few pips below the low. That trend is broken, because if we're going up, we keep making higher highs like this. If we're going up and then all of a sudden it comes down on us, we no longer have an uptrend. We may have a bullish candle to tell us that it's an uptrend, but if it breaks the previous low, that trend is no longer valid. So that's what you do. So you just put 150 pip stop loss for this one, and I'm going to move on to a downtrend, and then I'm just going to kind of wrap up the video and talk to you for a little bit. But we're going to move on to Euro USD because it's been one of my favorite pairs for the week. If my freaking chart will load, I may have to pause the video. Oh, no, I didn't have to. Nice. I'm running a screen capture software, so it makes my computer run kind of slow, so bear with me if it lags a little bit. But it's the same thing with downtrends. You're just going to have to put it at the previous high. So for uptrends, you put at the previous low, calculate the pips, and then you punch it into the calculator that I'm going to show you. For downtrends, it's just the previous high, because if a trend has not broken the previous high or low, the trend is still valid, and you need to only be looking to take trades in that direction. So for a downtrend, you're just going to put it at the previous high. So I'm going to plot some just normal support and resistance lines. I'll just plot it real quick. Doesn't have to be perfect, because I'm just trying to show you an example, and then you guys can apply it to whatever chart you're looking at. Now with this massive bullish candle bearish candle right here, you can see we broke support and we dropped 500 pips. I was actually in this trade with my students. I think I got like 200 pips. I missed the initial break because I just wasn't trading, but I know some of my students actually got like the full 500, and that made me really happy because they were looking at the right thing. Now if you got in right here and you're like, okay, well this is true support. Now personally, to me, since I see these candles right here and it went up, I probably would have waited for price to hit right around 1.10950 before I would have gotten in it to guarantee that the previous low was broken, which is right here. But I know a lot of people that saw a ton of support right here and they just got in at the beginning and they got lucky. So that's good for them. They made a lot of money. Now for this, if you decided, okay, I'm going to get in right here, where is the previous high of this sideways market right here? Now this is a lot of days worth of data, and I know a lot of people online were saying, where the heck is euro dollar going? Nobody could figure it out, and a lot of people tried to predict it, and I was just sitting around waiting for it to break true support or resistance. That's all you got to do. You just got to focus on your charts. You can't analyze the market. What do you think? Like, oh, all these fundamental things are going to work? How many people that you know only trade fundamental news? I know a lot of people do, and I know a lot of people that are successful with it. But to understand what the market's actually doing, you have to apply some sort of price action mastery with it. You have to know price action on top of fundamentals. I think you can't just trade price action without fundamentals, and I don't think you can trade fundamentals without price action. That's just my opinion, because you have to have both. Because if you're getting in a trade and then some high volatility news comes out and you just get whipped all over the place and your stop loss is horrible, that means you don't know price action and your risk management was off. So you're not doing correct risk management in the first place. Now, if you're trading price action, or if, you know what I'm trying to say, if you're trading price action and news comes out and you get whipped all over the place, that means you weren't looking at fundamentals. Now, if you were looking at fundamentals, you saw a news event come out, you traded it, it went in the wrong direction, and your stop loss wasn't there for your 1 to 2% loss, then that means you don't understand price action. Sorry, got a little bit mixed up. Hopefully that made sense. Now, the previous high for this little sideways market right here is just this little candle right here. Now, a lot of people would say this right here, and I probably would have put my stop right there just because I see it went sideways so much. But if you were applying the rules just from the textbook to the computer or your tablet, whatever you're trading from, it would be above the high right here. So that would be right here. Now, if you said, okay, Nick, I want to get in right here, I got to calculate my stop loss. So all you would do is, I have an easy ruler tool, so I'm just going to be lazy with it. If you don't know how to calculate pips, there's a lot of free websites that you can go to, and I teach it as well, but it's really not that hard to learn, so I think you can learn it for free before you come to Pips University. Now, all you'd have to do, let's just say you got in right here, how far away is the previous stop? Now that's 291 pips. This is off a daily chart as well. Now, many people, whenever I show them a big stop loss like this, they freak out. They're saying, oh my gosh, I'm going to lose this much money? 291 pips is so far. Well, if you have a risk to reward ratio, if you knew it was going to break, or you thought, okay, well, I think it could go 500 pips, I'm going to risk 300 to make 500. I'll take that trade all day. Because at the end of the day, it's not about how many pips away it is. It's how big your position size is. Position size is for that stop loss. Now, if you have a big trade going and it's that big of a stop loss, then yeah, you're going to be in trouble. But if you use the calculator that I'm going to show you right now, actually, and you just simply punch in the numbers of your stop loss, then you're only going to be losing 1 to 2% anyways, and you're going to be trading with correct price action. So I think you guys get the basics of what I'm trying to tell you here. If it's an uptrend, just plot the support line, or whatever you want to call it, stop loss, at the previous low. That will confirm that the trend is no longer valid. If it's a downtrend, plot it at the previous high, and that will tell you that the trend is no longer valid. Very simple stuff. Calculate the pips, and then use this position size calculator. You don't have to use this one exactly. There's a lot online. And I'm going to exit my screen real quick, so bear with me if my computer freezes up. But I'm going to be using the myfxbook.com position size calculator. We're verified investors on myfxbook.com, so I'm always on the website, so this is just easier for me to do because I'm already on it. It takes me 5 seconds. Now, the way this calculator works is it's going to tell you what your account currency is, your account size, your risk ratio, which is 1 to 2% for me. You don't have to follow it. I'm not liable for any loss you have with your money. Your stop loss, and then you choose your currency pair. So I'm just going to show you an example of how this works. Let's just put $1,000 for the account size. Let's say your risk is 2%, and then your stop loss is, let's say, I don't know, let's say it's 40 pips. 40 pips away from where you want to enter. This tells you that you can risk a maximum 5,000 units per trade. If your trade goes negative on you, 40 pips, that still means you're only going to lose 2% of your account. Now, a lot of people associate risk management with small position sizes, and sometimes that's the case, but the smaller the stop, the bigger the position size. The bigger the stop, the smaller the position size. So you can still make money. It just is based off your stop loss. So let's say the stop loss is only 10 pips. Let's see how the units down here change for you. So now if the stop loss is only 10 pips away from where you want to enter, that's 20,000 units, which is $2 a pip. I'm getting confused seeing all these numbers. Now, whenever you change the currency, let's just change it to a random one. Let's just put Australian dollar CAD. It will change. It's based off the rate. There's a bunch of calculations. I can send you the formula on the email if you want, but this is just a simple way to do it. And the way you do it, you just go to myfxbook.com, click Forex calculators, and then go down to Forex position size calculators. And this is the one that I use because I'm already on it usually every day. So that's how you're going to do it. And you can change it up. You can do 1%, 2%, 5%, whatever you think. My maximum per trade is 2% per trade, no more. But if I see that I want to take 5 trades, then I'll only do 1% per trade, and that'll be a total of 5%. And the reason why I do that is because whenever you trade 5 trades, you have a better probability of winning than just trading 1 or 2. So I don't mind to risk that a little bit more because I have better odds of winning. It's all about probabilities in Forex and having the best possible situation for you. I hope this helps any of you that are getting into the Forex market, and I want you guys to stay positive with your trading, because investing is a beautiful world. It's an art. We're in the most high-class professional industry I think that you can possibly be in. There's doctors, there's lawyers, there's investors, and it's just a beautiful thing to say that I'm a Forex trader. And I think it's just really awesome, especially whenever you can learn to manage your emotions. And I think many people have emotions in the Forex market because their risk management isn't correct. Now, if you're only risking 1 to 2% of your account, I don't care if you're trading a $20 account or a $1 million account, 1% of your account, it's not going to hurt you. You're going to be like, oh yeah, well, it would really suck to lose this one. It's just going to be annoying. But it's not going to hurt you. 1% is nothing. That's why it's so important. It's about staying in the game. It's the process, not the profits. Remember that. One trade won't make you. One trade won't break you. That's my concept. Apply it. Apply this. Focus on risk management. Stay in the game. It's just like working out. I know a lot of us on here, we're not in the best shape that we could be. Now, I know if we started 5 years ago, I'd be looking pretty good right now. But right now, I don't even want to take my shirt off to go to the pool. So if I started 5 years ago, I probably wouldn't even own a shirt. So that's basically how investing is. Start and do it correctly. Have correct form. Just like working out, you got to have correct form to make the best possible gains. So with trading in any market, do it correctly. Now, this applies to any financial market that uses candlestick data analyzation, so you can use these same stop losses. For any financial market, it'll just be a little bit different with how you do that in the formula, and I don't think you can use this calculator on it because this one is specifically for Forex. But if you trade Forex, this is a great calculator. Again, just go to MyFX book. I am not associated with them at all. They don't give me any money at all. I just use them. This is a simple one for me, just showing you a free tool that I use. If you just type in on your favorite search engine, Forex position size calculator, there's tons of them on there. But since I'm on this site every day already, it's really not a big deal for me to use it. So I hope this helped you. Sorry if I blabbed and just talked your head off, but I think you guys are really going to enjoy this. Again, check all the links below. Subscribe, like the video, share it with all your trading friends. Again, I'll see you on the next one.